We've seen the data. Private equity has outperformed the S&P 500 for decades. Real estate provides passive income and tax advantages. And infinite banking gives you financial flexibility without being at the mercy of the stock market or with banks. The question is, are you investing like the middle class or like the wealthy?
This is my time. I'm on the ride.
Hi, I'm Kyle Stephenson, and you're listening to the Assets and Orthopedics Podcast. In this forum, we hope to educate medical students, residents, physicians, and other high-income professionals on the power of investing, especially in real estate assets and syndications. We want to help providers gain financial intelligence with the hope of earning financial freedom. Please listen and learn so you can spend more time doing what you love with who you love. Enjoy the podcast.
I go 100 all day.
Hello and welcome to the Assets and Orthopedics Podcast. This is your host, Kyle Stephenson. Up until now, we've had incredible guests sharing their experience and expertise, and I've loved bringing those conversations to you. But moving forward, I'm actually going to make a shift. And this is the first episode of that shift. I want to start bringing you more direct, no fluff episodes where I share the insights, strategies, and wealth building principles that I believe can truly change your financial future. These will be shorter, high impact solo episodes. They'll go for about 20, maybe 30 minutes. And I'm going to break down the exact frameworks and the strategies the wealthy use to create financial freedom, passive income, and generational wealth. Don't worry, the guest interviews aren't going away. These solo episodes will give me the chance to go deeper into certain topics, however, and I want these episodes to bring massive value to everyone. So we'll still sprinkle some interviews along with these, but this will be the mainstay. And if you have any topics or ideas that you want me to talk about, do some research on and explore, then please reach out and let me know. So today, we're diving into a topic that will completely shift how you think about investing. If you've been following the traditional financial advice, maxing out your 401ks, throwing money in the index funds, hoping the stock market delivers, which today we're seeing that the stock market is down, crypto is down, and we can talk about that a little bit, but when you do these things, you're playing a different game than the wealthy. And it's time to change that. So all of this starts with mindset. And this episode hopefully will get you start thinking like the wealthy, get the wheels turning, and you can start doing your own research. But the truth is, ultra high net worth individuals, people that have a net worth of over 30 million, are considered ultra high net worth. These individuals don't build their wealth with 401ks or IRAs. Instead, they focus on certain key investment vehicles: real estate, private equity, and although it's not an investment, they leverage an infinite banking policy. So real estate provides passive income, there's tax advantages, and they typically, real estate typically appreciates. Real estate doesn't necessarily correlate with the stock market, which is always nice. Private equity gives access to high growth companies before they go public. And not everybody has access to private equity investments, but I will say there's some terminology of accredited investor versus non-accredited investor. I talked about on one of my earlier episodes, where an accredited investor is probably most of you listening. There are a few key things, but you have to have a net worth of over $1 million. Or you make over $200,000 filing single. And if you file jointly with your spouse, you have to make over $300,000. That makes you an accredited investor. And with that, with being accredited, you have more opportunities to invest in certain real estate deals and private equity. But I would tell you, for real estate, you don't have to be accredited. That's the beauty of it. You can be non-accredited and still invest in great real estate deals. Private equity is a little bit different. And then infinite banking is the third topic that allows the wealthy or anybody that utilizes this concept, allows them to control and leverage their own money while keeping it compounding tax-free. That's the important part. All right. So the wealthy are good at making money, passive income, and minimizing their taxes. All right. We'll get into all this. So I hope to show you a lot of proof of this today. All right, I want to start off. So Tony Robbins has a couple of great books about investing in general. He's a big fan of Ray Dalio. If you don't know Ray Dalio, look him up. He is one of the smartest investors out there, him and Warren Buffett. But two books that Tony Robbins wrote that are fantastic. One is Money Master the Game, and the other one is called the Holy Grail of Investing book. And we're going to start off talking about the Holy Grail book. So this book really dives into the realm of alternative investments, shedding light on strategies traditionally reserved for institutional investors and the ultra wealthy. But he breaks it down into things that, that we can invest in, the normal person can invest in. But really the big part of that Holy Grail of Investing book is, what are some investments that don't correlate with the stock market? So he actually mentions in there, Tony Robbins mentions that a lot of people are obsessed with crypto. Crypto has been positively correlating with the stock market. Bonds have been doing the same thing. Post 2008, bonds and stocks have very much been in line with each other. So it used to be bonds were a good way to offset if the stock market goes down, or hedge against the stock market. But it's not really the case anymore. And then with crypto, as you can see, today is March 11th. Look at the stock market and look at crypto. Both are down right now. And it seems to be the case on a macro level as well. For all of you that still love crypto, this is a good time to buy for you, right? But I'm just throwing that out there, generally speaking. So in this book, The Holy Grail of Investing, he talks about the ultra wealthy families allocate nearly 46% of their portfolio to alternative investments. And that's private equity, real estate, hedge funds. So 46 of their portfolio is alternative investments, compared to only 29% of publicly traded stocks. And I think that this is like the opposite of where the middle class think, right? We're all about stocks and bonds. And even a lot of physicians and people I work with, or any high income professional, we all pretty much think that stocks and bonds are like the thing, or, crypto. But they're showing that they do, their allocation is 46% alternative investments, 29% publicly traded stocks. And over the past 35 years, private equity has outperformed public markets in 34 of the last 35 years. So private equity is 14.28% annual returns versus the stock market of 9.24% for the S&P 500. That difference can turn $1 million into $26 million versus $139 million. So think about that one. All right. What else do the ultra high wealthy invest? So you got 46% here, you got 29% here. There's still some other investments. So what are they? We're going to break it down later in the episode. All right. So if you want to think and invest like the wealthy, this episode is for you. I'll break down the key lessons from Tony Robbins' books and from Robert Kiyosaki, and show you how to shift your investment strategy for long-term wealth and financial freedom. So let's dive in. First of all, where do most people get financial advice? Do most of us just trust the advice that we get? Do we ask questions? Are we curious? We advise our kids to be curious, ask questions, please. But I'd say that most adults are not. We're pretty stuck with, what we've been taught by somebody. We're not really sure who that somebody is. Maybe it's our parents, maybe it's a financial advisor, but we'll get into who most people listen to. But we tend to keep our heads down. We hand our money over to the government and taxes. We hand our money over to the companies we work for in certain fees, and this and the other. We hand it over to financial advisors and just say, take our money. We trust you, and please, make me money. Well, that person has to make themselves money too. So where do we typically get our financial advice? Well, I would say number one is family and friends. It's the most common, but it's often the most flawed as well. People tend to follow what they grew up seeing, right? Whether it's good or bad, it's what their parents did or what their grandparents did. If their parents relied on a 401k or an IRA or traditional savings, they assume that's the only way to go. Many of these sources lack expertise, only know what worked decades ago, which is very different than now. We could get into quantitative easing and, why inflation is up so high. But, things have changed a lot over the years. And so you really do have to have financial intelligence, try to understand this stuff so that you don't get, caught in the, in your retirement, expecting your 401k to save you. So the second place where we get most of our advice is from financial advisors. And those financial advisors have to eat, they have to live, right? They're selling products. They do a good job because they study everything, but they also got to make money too. So there are fees that a lot of times are hidden. Really understand where the fees are coming from. But these financial advisors are, banks, investment firms, insurance agents. They push certain things that they sell, 401ks, mutual funds, life insurance. They have commissions and fees. that drive many of the recommendations, right? The things that they push will often benefit them more than the client, which sad, but probably true, right? Many advisors follow a one-size-fits-all script instead of truly educating clients on alternatives like infinite banking, real estate investing, or passive income strategies. The next one is mainstream financial gurus. So we all have read a book or seen Dave Ramsey. We've heard of him. He is a big one out there. Susie Orman is another one. They live in a nice, beautiful home, but they preach to us, avoid debt, invest in index funds, live well below your means. Now, I think that they speak mostly just from what I've experienced, what I've heard, and, listen to, read their books and all this stuff. And, it's really, are you a Dave Ramsey guy or are you a Robert Kiyosaki guy? And I think as you go as physicians, when you're a resident, you're kind of like, all right, I'm Dave Ramsey. I'm trying to avoid debt, minimize my expenses, kind of live like a resident, if you will. Robert Kiyosaki makes you think big. He's thinking more like the wealthy. And so Dave Ramsey, I think he speaks more to truly the middle class or the people that have credit card debt or, certain debts they need to get out of. Like, he definitely speaks to those people. He's not really speaking to the people that want to buy real estate investing, want to get involved in infinite banking, want to really think like the wealthy. I'd say Robert Kiyosaki is more that way. So Dave Ramsey, Susie Orman, they preach live below your means, avoid debt, invest in index funds, buy term life insurance, and invest the rest. They're good for beginners. They don't teach high-income professionals, however, how to leverage money efficiently. Their advice is designed for the middle class, not for people who want to create generational wealth or escape the rat race. And that's the important part. All right, let's keep going. Social media and YouTube. There's a mix of good and bad advice on there, right? It's hard to know who to trust and who not to. Some channels teach legitimate wealth building strategies, of course, but they obviously want to sell something as well. Others promote get-rich-quick schemes or high-risk investments, and it really shouldn't be that way. Nothing that we do is going to be get-rich-quick. If it is, it's flash in the pan. Or it's a scam of some sort. When we talk about real estate investing, we talk about infinite banking. These are tried and true concepts that it's delayed gratification. It's something that it's a lifestyle change, essentially. It's kind of like, diet and exercise. You're not going to get a six-pack overnight. You got to work hard. You got to work out. You got to have discipline. Same thing goes with investing. If you really want to be wealthy, it's delayed gratification. It takes time, but compound interest is on your side, and that's the beauty of it. So without your own financial literacy, it's hard to separate smart strategies from the hype regarding social media. So be careful. Crypto one day is the best thing ever. Who knows what they're hyping, but it's always it's hard to know what's hype and what's not. So really do your own due diligence. Employer benefits and HR departments, they mostly push certain, traditional retirement plans, 401k, IRAs, pension. Employees rarely get education on alternative investment strategies like real estate, private equity, or tax-advantaged wealth building. So these plans can limit access to funds, expose people to market volatility, and create a false sense of security. We'll get into 401k and why I don't love the 401k. And I've been wondering for years why Robert Kiyosaki would say that. And it's made more sense these last few years, really. Now, I've had multiple conversations with my own CPA, and he agrees with what I'm saying about the 401k. So where do high-income professionals get their financial advice? Well, they get them from other entrepreneurs. They get them from other investors. They have wealth-building mentors. That's an important thing to have. People who have already built financial freedom through real estate or private investing or alternative strategies. That's who you should talk to, right? And then there's books and podcasts that were made, by self-made wealth builders. And I think that's the best way to go. I keep telling you that, if you listen to a podcast and if you read books, you'll get ahead of 90-something% of people because most people just don't want to do the work. Now, there's a difference between just reading the books and listening to the podcasts and actually doing. I have this quote where the quote is, be a dreamer, but more importantly, be a doer, right? So you can dream all you want, but you got to take action. All right. So be a dreamer, but more importantly, be a doer. So instead of listening to, save gurus or live below your means, follow those who use money as a tool to create freedom. So most people follow outdated financial advice that keeps them trapped in the system. To build true wealth, you have to seek advice from those who have actually created it, not just those selling a product. All right. So this is a cool next aspect of the show. A couple different books I read this in, and I started diving deep into it. But Money Master the Game by Tony Robbins, awesome book, and he has this pie chart. So here we go. He talks about the golden egg. So hopefully you can see this on YouTube. If not, I'll explain it to you. But basically, there's a pie chart, and at the very top it talks about actual income for life. So where does your money go over a lifetime, right? You make money, but you got to pay it to other people before you start using it. So Robert Kiyosaki's quote that I love is, it's not about how much money you make, it's how much money you keep. And what is he talking about? Well, the biggest expense, everybody knows this, right? The biggest expense is taxes. It's not just federal income tax either. State tax, sales tax, property tax, capital gains tax, payroll tax, hidden tax. I mean, there's tax on everything, right? On average, people, at least high income professionals, will pay about 54% in taxes overall. Okay, that's federal income tax, state income tax, county, all your sales tax. Every time you buy an item at the store, you're paying sales tax. Every time you live in a house, you're paying that tax. There's always tax, right? So 54% of your income comes out in taxes. All right. So take your income that you make, take out 54% of it, and that's what you have left. All right. Of the remaining, what's the next biggest expense? It's interest payments. Many people pay a third of their lifetime earnings in interest. And this is financing everything: your mortgage, cars, student loans, pretty much anything that you're financing. Those interest payments add up, right? So again, right off the top, 54% of your income goes to taxes. And then from that, what's left over, 34% goes towards interest. That alone, if you could just keep that money that you had in taxes and interest, you would be wealthy right there. All right. So then what's left over? So that's 72.5% of your income that you make is gone off the top. So what do you have left? You have 28.5% left to pay for your lifestyle and to build a critical mass for financial freedom. That's what you have to invest. All right. There's investment fees that people pay, right? 5 to 10% is what he's saying. And Tony Robbins says 5 to 10% at a 401k or mutual funds or financial advisors. There's fees, there's hidden fees, there's things that we don't see. Just because you pay the 1% to your financial advisor doesn't mean you're not paying fees every time they, buy and sell stuff. 401ks, we don't even know what the fees are, but they're a lot more than what we've been told or, what we think. And of course, Tony Robbins talks about even a 1% difference in fees can cost you hundreds of thousands or even millions over your lifetime. All right. Next, you have living expenses, right? You got to live and you don't want that to change. So living expenses, 10 to 20% based on the lifestyle. But what's left after taxes, interest, and fees goes towards your housing, your food, your travel, discretionary spending. And then lastly, most people save and invest last. After all that, now okay, whatever I have left over, I save and invest. Whereas Kiyosaki and Tony Robbins, all these guys are saying, no, pay yourself first. Pay yourself first off the top, and then everything else. But most people don't save enough. Most people don't invest enough. Your goal should be to automate your savings, invest in assets that generate income, build passive income streams. And from everything I've read, we should be investing at least 20% of your gross income, not post-tax income, your gross income. So take your gross income times 20%. You should be investing that every year for sure. 20% I think is on the bottom. If you really want to be aggressive, it could be 30% or even more. All right. So key takeaways from Tony Robbins: minimize taxes legally through tax efficient investing and deductions. He talks about retirement accounts, 401ks, which we got to be careful on. I would argue that infinite banking is better than a 401k and retirement accounts. And we'll talk about that. And we'll talk about infinite banking and the power of that combination of infinite banking with real estate investing to minimize taxes, minimize interest. And that infinite banking is basically being your own bank. All right. If you listen to my previous podcast with Hannah Kessler, Brent Kessler, Devin Burr, it's really cool concepts. So you want to reduce your interest payments by avoiding bad debt, using smart leverage, Again, infinite banking, cut unnecessary investment fees, increase savings and investments. And we just talked about that. Pay yourself first. All right. We talk about the stock market. So this is pretty interesting, actually. A lot of cool, books talk about this. I mean, it's not intuitive necessarily. So I wanted to get into this, but if you told me that you just do index funds, you just invest in index funds, S&P 500. I'm a big fan. I'm a big fan of John Bogle. Instead of handing my money over to somebody else that's going to invest in mutual funds or index funds, I like putting in an S&P 500 because, studies have shown that nobody can trade enough to beat the S&P 500, right? And they say that the average rate has been around 9 to 10% over the last 30 years or, even 100 years. So the average return of the index fund stock market has been 9 to 10%. But what is the actual return in the stock market? That's the question. There's a big difference between average return on investment and actual return in the stock market. It's a crucial concept that many investors misunderstand. So let's talk about it. Are you really making that 10% a year? That's the question. So it can be misleading. And a lot of times it's pushed by financial advisors because it looks good, right? They're like, why would you put it in anything else? It's the S&P 500 makes you 10% a year. Good luck. You got to beat that. Well, the average return is simply the mean of returns over a period of time. Okay. So it does not account for compounding or losses, which is why it can be misleading. This average return is the number most financial advisors and mutual fund companies advertise. They do it for a reason. All right. So let's just take an example. If you have $1 million in your index fund, it goes up 50%. All right. So $1.5 million. And then at that, it goes down 50%. Now you're at $750,000. All right. But if you average return the calculation of the percentages, it went up 50%, went down 50%. The average return is 0% return. Well, it sounds great, but what's the reality? The reality is the actual return. So this considers compounding and volatility, and it's the return you really get when investing. Losses actually hurt more than gains help because you need a bigger percentage increase to recover a drop. All right. Let me say that again. Losses hurt more than gains help because you need a bigger percentage increase to recover a drop. So same example as above, but with actual returns. All right. Instead of $1 million, let's keep the $1 million. So you start with $1 million. It goes up 50%. You now have 150, or then you have 1.5 million. Excuse me. Now it goes down 50%. You now have 750,000. So you start with $1 million. You now have 750,000. Whereas the average return said it's 0%, but in fact, you lost money. So even though the average return is 0%, you actually lost 25% of your money. This is called volatility drag, where market downturns significantly impact your long-term wealth. So why does this matter for investors? Financial advisors promote average returns, which look way better. Your actual return is always lower when factoring in losses and volatility. The more volatility in your portfolio, the lower your real return over time. And a stock market reality check, S&P 500 advertises the average return is 10% per year over decades, but actual returns after inflation, volatility, and fees are closer to 6 to 7% per year. So even though they advertise 10%, it's really 6 to 7%, taking in all those factors. And again, in one of Tony Robbins' books, I think it is Money Master the Game, he actually goes through some examples. There's a difference even if when, say over 20 years, somebody starts with a certain number compared to the next person. Let's say they have the same exact number that they start with. Every year that has a plus is the same as the other one that has a plus. And every year that has a minus is the same exact as, the other person that has a minus. It's just they're in different orders. And the order of when the market goes up versus when the market goes down actually changes your returns as well. So it doesn't really make a lot of sense necessarily. You got to see it in the book. But all in all, what we're saying is, volatility matters. And that whole point of losses hurt more than gains help is something to understand. Final takeaway from that section really is don't fall for the average return trap. What really matters is your actual compounded return after volatility, taxes, and inflation, which is why stock market investing isn't always the best long-term wealth strategy. Again, the wealthy do put their money in it. They just don't put majority of their money in it like we as the middle class do. All right, let's move on to Robert Kiyosaki, breakdown of the middle class versus the wealthy. He has 2 great books, Rich Dad, Poor Dad, and The Cash Flow Quadrant. I want to get into this quick because my last webinar, we actually went into this. So the cash flow quadrant, 4 ways that people make money. So you can see that Kiyosaki divides income earners into 4 quadrants. You have on the left side, you have your employee, E, which is your middle class mindset. The E trades time for money. You have salary and wages. And this is, a lot of physicians are in the E. Most physicians are really on the left side of the quadrant, E or the S. So E trades time for money, has little control over income. If they stop working, they stop earning. They pay the most in taxes, or they pay a lot in taxes. Earned income is at the highest tax. And examples of this, a doctor, a lawyer, office worker earning a high salary, but still dependent on their job. How about S? That's middle class trap. They work for themselves, but they still trade time for money. They believe if I want it done right, I have to do it for myself, or I have to do it myself. It's hard to scale wealth because income is limited to personal effort. An example of this is a small business owner, a freelancer, or a consultant. A lot of times, doctors and dentists are in this category because you're self-employed. So you're either W-2 or you're self-employed. So again, doctors and dentists are on the left side of this quadrant. And then on the right side, you have a big B, business owner. They have the wealthy mindset. They own a system that makes money. Even when they're not working, they could be anywhere in the world and their machine or their business is still running. They leverage employees, automation, or investments to scale their income. The owner of a successful company or franchise who builds assets, not just a job. That's the example of this person. And then lastly, you have I for investor, where the wealthy play. This is where the quadrant where money works for the person. They invest in cash flowing assets. They focus on real estate, private equity, and business investments. They pay the least in taxes by using legal loopholes like tax-free growth, depreciation. An example of big I is a real estate investor or private equity partner. Key differences of the middle class versus the wealthy. All right. The middle class is on the left side, E and the S. They work for money. They're dependent on a paycheck. They pay higher taxes. Kiyosaki states that the E pays around 40% in taxes, whereas the S actually pays 60% in taxes because you're paying personal and your S corp or your business taxes as well. Middle class saves in 401ks and IRAs. They fear debt. They prioritize job security. The wealthy, on the other hand, your right side of the quadrant, the B and I, they make money work for them. They have multiple income streams. They use tax strategies to pay less. They invest in real estate, businesses, and private equity. They use good debt to build wealth. And they prioritize financial freedom. So again, Robert Kiyosaki talks about good debt, using debt to your advantage to buy a business, to buy real estate, to buy money-producing assets. Whereas the middle class fear debt. They want to stay out of as much debt as possible. But that's consumer debt that we're talking about there. So what are Robert Kiyosaki's biggest lessons? Well, the wealthy own assets, not just jobs. In his book, Rich Dad, Poor Dad, Kiyosaki explains how his rich dad, his mentor, taught him to focus on acquiring cash flowing assets instead of working for a paycheck. Middle-class workers focus on earned income, they work on jobs, while the wealthy focus on passive income or investments. The quote is, "The rich don't work for money, they make money work for them." How do you apply this wealth strategy? You move from the employee or self-employed on the left side to the business owner or investor on the right side. I think the easiest thing to do is to move to the I quadrant, which is the investor. So invest in real estate, private businesses, cash flowing assets instead of relying on a salary. Use that salary to invest in those assets and let those grow over time. This takes time. This is not get rich overnight. Again, as I've stated 100 times. And I'm still in that process, but I'm loving it. And then another thing you can do is use infinite banking to fund investments without relying on banks. If you have your own bank, which is the infinite banking concept, then you can utilize that as opposed to going to an actual bank where you're paying interest on your loans. And then focus on financial education to escape the 9-to-5 mindset. The bottom line, the middle class work for money, the wealthy build assets that generate income so they never have to trade time for money again. All right? So I introduced it at the beginning. The whole, the Tony Robbins book, Holy Grail of Investing, why the wealthy avoid the stock market. Again, they talk about, in that book, they talk about uncorrelated investments. And it talks about 7 uncorrelated investments. But, again, crypto, the stock market, and bonds are all becoming pretty correlated. And so you got to think of other things that when those drop, you're still sitting pretty, right? You have real estate. Do you have a business? Do you have something else that's doing well for you? Or are you just depressed because your 401k is down, your IRA is down, your crypto is down, and it's all down at the same time? So the wealthy use investments that are uncorrelated to the stock market, just like I said. Private equity and real estate dominate wealthy portfolios, as I talked about. Ultra wealthy, ultra high net worth, families that make over 30 million allocate 46% of their investments to alternative investments. And what does that look like? They have over half invested in private equity, with the balance nearly equally divided between real estate at 25% and hedge funds at 23%. So most of it is private equity, and then 25% real estate, 23% hedge funds, and then 29% is stocks. Private equity crushes public markets. So over the last 35 years, as I talked about, private equity has outperformed public markets in 34 of the 35, averaging 14.28% annual returns compared to 9.24% for the S&P 500. That's the difference between 139 million versus 26 million on a $1 million investment. I thought this was pretty interesting. Fewer public companies equals fewer opportunities. What do I mean by that? The number of publicly traded companies in the US has actually dropped by half since 1996, making the stock market investing more concentrated and riskier. As you know, with the S&P 500, I mean, the top 7 companies dictate pretty much how those S&P 500 runs. Those top 7 companies are the biggest companies. But overall, publicly traded companies in the US dropped by half. 4,400 companies for investors to consider at this point. That's pretty wild. So in fact, back in 2009, 81% of public companies were profitable. By 2021, only 28% were profitable. By contrast, there are tens of thousands of private companies growing, innovating, and disrupting. Approximately 80% of all companies with more than 100 million in annual revenue are privately held. When you look at the total value of all publicly traded companies globally, you may be shocked to learn that the value of all the companies held by private equity funds dwarfs public stocks by nearly 4-1. It's not to say that public stocks don't have a role in our portfolios, but private equity is killing it when it comes to this stuff. And so all it does is makes us think, and maybe should make us dive deeper into the private equity space. With the wealthy focus on cash flow, not just growth. Instead of waiting for their 401k to grow, wealthy investors leverage private deals, real estate, and business ownership for consistent passive income. All right, so we know that 46% alternative investments, 29% publicly traded stocks. What else do the wealthy invest in? 10% private credit. They lend to businesses and individuals outside of traditional banks. So they could be a private lender. That's 10% of what they invest in. And then they have 10% in commodities, or that's gold, silver, oil, collectibles, art, wine, rare assets, or sports team ownership and venture capital. That was cool. One of the chapters in that Holy Grail of Investing book actually talks about being a sports team owner. You can have minority shares as an owner as well, which is pretty neat. So, and then 5% in cash and cash equivalents, liquidity and money market funds, treasuries, and reserves for opportunities. With the infinite banking policy that I talk about, it's actually liquid. You can use that money to invest it in real estate. You can use it to buy a business. You can use it to pay off your car if you want to. You can use it in all ways. It's infinite, right? You can use it doing whatever you want. The beauty of it is when you're using it, it's still working for you, making about 5% guaranteed, which is really cool. So we'll get more into infinite banking, but I think it's a cool concept for a lot of people to understand. But we want to really talk about investments here, and the infinite banking is more of a savings account, if you will, that can really accentuate your investing. The wealthy don't rely on 401ks, mutual funds, index funds. They own private businesses. They invest in private real estate. They leverage assets that compound wealth faster. If you want to escape the traditional retirement trap, it's time to think differently about where to put your money. All right, let's wrap this up. If there's one thing I want you to take away from this episode, it's that the wealthy don't rely on 401ks, index funds, or mutual funds to build lasting wealth. They invest in assets that give them control, cash flow, and long-term growth. real estate, private equity, and as a way to be your own bank with infinite banking. We've seen the data. Private equity has outperformed the S&P 500 for decades. Real estate provides passive income and tax advantages. And infinite banking gives you financial flexibility without being at the mercy of the stock market or with banks. Question is, are you investing like the middle class or like the wealthy? Now, here's the exciting part. Next episode, we're going to dive in deeper into one of the most powerful wealth building strategies that the wealthy use. This is something I like and I've been getting into on my podcast recently. Infinite banking plus real estate investing is a powerful tool. We're going to talk about how to use a properly structured whole life insurance policy to create tax-free wealth, invest in real estate, and build financial independence without relying on banks. If you've ever wondered how to fund your investments without draining your savings or taking on massive debt, this next episode is a must listen. Make sure you're subscribed so you don't miss it. And if today's episode got you thinking differently about investing, share it with a friend who needs to hear this. Pass it around. Give me some feedback, please. Reach out to me, text me, call me. If you have any issues, make a note on YouTube. And please give us a 5-star review if you don't mind. Or a 5-star rating if you don't mind, and give us a review. All right, that's it for today. See you next time.
This is my time. I'm on the rise. Can't hold me down.
Thank you for listening. If you found value in today's podcast, please leave a review so our community can continue to grow. If you would like to stay connected or receive a copy of your free investing ebook, please go to www.sharpinvestmentsllc.com, and that's sharp with a P as in professional. This is not financial or tax advice. Please consult with your financial advisor or CPA.